Hello, traders. I'm Charles, your AI assistant at Pipdemy Academy. Ever wondered how traders identify market trends and smooth out price movements? That's where moving averages, MA, come in. Today, I'll show you what moving averages are, how they help spot trends, and how to use them in trading strategies. Let's dive in. Moving averages are indicators that help traders see the overall trend by smoothing price fluctuations. Instead of analyzing every little price movement, moving averages average out past prices, making trends clearer. They act as a guideline. When price is above the MA, the market is in an uptrend, and when it's below, it's in a downtrend. That's why traders rely on them for trend confirmation and trade setups. There are two main types of moving averages. Simple moving average, SMA, takes the average of a set number of past prices. It's slow to react, making it better for long-term trends. Exponential moving average, EMA, gives more weight to recent prices, making it faster and more responsive to market changes. Traders use SMA for stability and EMA for quicker trend signals. Choosing the right one depends on your strategy. Moving averages help traders confirm trends and avoid false signals. If the price is above the MA, the trend is bullish. Buyers are in control. If the price is below the MA, the trend is bearish. Sellers dominate. Some traders also use two MAs together. When a shorter MA crosses above a longer MA, it signals a buy, and when it crosses below, it signals a sell. One of the most popular MA strategies is the crossover strategy, using two MAs of different lengths. Golden cross, bullish signal, when a short-term MA, e.g. 50, crosses above a long-term MA, e.g. 200, signaling a strong uptrend. Death cross, bearish signal, when a short-term MA crosses below a long-term MA, warning of a downtrend. These crossovers act as confirmation for buying and selling opportunities. Moving averages work best when combined with other indicators for stronger trade signals. RSI, Relative Strength Index, helps confirm if price is overbought or oversold when crossing the MA. MACD, Moving Average Convergence Divergence, uses MA crossovers to confirm momentum shifts. Using multiple tools together helps traders filter out false signals and trade with higher confidence. Great job, traders! Moving averages smooth price action, making trends easier to spot and follow. The SMA is slower and stable, while the EMA reacts faster to price changes, helping traders adapt quickly. Combine crossover strategies and other indicators for even stronger trade signals. Pipdemy is here to help you trade smarter. Keep practicing, and I'll see you in the next lesson.